So you're saying stage one of this whole reopening play, pretty much priced in. What does stage two look like to you?
Well, I think stage two, we have to be a little bit cautious because from November to now, it's been such a big rally, in the equity markets, the FX markets, the credit markets, especially offshore, like the Hang Seng China Enterprise Index up 50% since November. But the onshore equity market, CSI 300, only up about 15%, only 15%. I think this shows some of the flows as well as the composition of the stock indices. So a lot of the fast money hedge funds in Hong Kong have covered their shorts in Hong Kong, actually. And the money flew in quickly to Hong Kong, and it drove up the offshore indices. But I think a lot of the big global real money asset managers who reduced their allocations to China, let's say second half of last year, they haven't come back in yet. So if they come back in, there could be another leg up actually later in the year. So we really see that. Also the composition. Offshore, it's been mostly a tech story. Big names like Tencent are up 100% since November, but they're still half where they were 2 years ago. Whereas onshore, a lot more will be industrials, consumers, financials, real economy stocks. So that will take a bit of time to recover, I think, but we'll see that for the rest of the year.
Have you started seeing inflows picking up, northbound, of course, into China?
We have, actually. So just in the first 2 weeks of the year, we saw about $9 billion US dollar equivalent flow northbound in Stock Connect, compared to only $13 billion for all of last year. Wow. So more than half of all last year. Now, that's more on pace for 2 years ago when it was about $55 billion of inflows into the onshore markets.
Oh, okay.
So if it continues at that pace, you can see where that could drive things up.
Is it still the equity market is where you play it, though? I mean, you mentioned about, it's everything from credit, FX, even, you take a look at when it comes to Australian miners are at record highs, right? Is it other ways to play it still?
I think the offshore equity is kind of priced in, at least for the time being. So the onshore equity would be still quite a room to grow. I think things like FX have already priced in, actually, because when dollar renminbi came in from 7.3 to 7, now at 6.7, it doesn't have a lot more to go in the short term. We think it probably trades between 6.7 to 6.9 for the next month or two. And in fact, if it goes much lower, if dollar renminbi goes much lower, if it goes to, let's say, 6.6, actually what that will probably do is give the PBOC a reason to lower their policy rates one time, because that will give the economic stimulus to help the economy grow a bit faster, but it also lets the renminbi strengthen a bit and the dollar renminbi to go up a little bit. So they're kind of comfortable in the 6.7 to 6.9 range. And credit, it's been a huge rally on the high yield side, but it's been a real bifurcation. In some ways, the winners and losers have been picked for the higher quality, let's say, property companies that have not defaulted yet. So the list on there was a government list of issuers that the government fund would protect the future issuances of, or the big six state-owned banks would provide credit lines for. These are in pretty good shape, actually. I mean, look, Dalian Wanda was able to come to market last week with an unguaranteed US dollar bond, 400 million, 12%, 12 and 3/8%. It's a bit pricey, but that's not bad compared to just a few months ago.
Well, very quickly though, what are you seeing as far as interest, though, the riskiest parts of this offshore dollar bond market?
I think it will take time for the interest to come back, I think. I think people are still mostly staying with the investment grade, but even the investment grade is interesting. Single A benchmarks like Tencent, Alibaba, these names, right? High 4% yields, that's okay, actually. Or the perpetuals of the state-owned companies and the AMCs at 6%, that's attractive for IG.
What do you make of just the macro backdrop now? It's almost like these two opposing forces, a China reopening, and then a U.S. and a Europe that's slowing down. And for markets to risk assets to really outperform, I think you have to have two of those things, like that Fed pivot and the China reopening, really kind of kick in and actually materialize. How confident are you of those two things actually making some sort of impact this year?
I'm confident of one and not so much confident of the other one. So I'm pretty confident that the China reopening is happening. I think they've changed too many policies in the last 2 or 3 months, and the central government has said economic growth is their priority for this year. So they're going full steam ahead at this point. There'll be some bumps because it'll take a while for consumption to return, for business sentiment to return. But I think the China side I feel pretty confident in. The global global one I'm a little less confident in because everything has been too perfect up until now in the beginning of the year. The warm winter in Europe, inflation coming down a little bit globally. So all this, and you see since just in the first 2 weeks of the year, equity indices in Europe are up almost 10%. Even the S&P is up 4% when everything should be recessionary at this point. So it doesn't feel quite right, actually. So it feels like there's a lot more room for the downside if anything disappoints going forward.
So is that more room for upside in inflation? Is that what you're trying to say also?
No. I'm saying if inflation doesn't come down as quickly as anybody thinks, maybe the China reopening adds another 100 basis points to global inflation, for example, as you see in the commodity prices.
Yeah.
So hence that's why China is trying to pull back iron ore prices now, right? Because I think we haven't even seen, oil prices have been very benign, actually, right? Oil prices, all the other commodities have been relatively benign. So if they start picking up because of the China demand, then that will have an effect on the global inflation outlook and therefore global growth at that point.